Hey everybody, welcome back. We are ready to knock out part 2 of our Chapter 7 in Solid Footing. We got a couple more adjusting entries that we're going to work through. We're going to review what we talked about in part 1 with those depreciating entries and add a little bit more to it. In all, we got 2 entire months that we're going to work through in our video today. February and March, and we got all kinds of adjusting entries that we're going to pull in here. So let's get right to it. Remember in our previous video, we talked about Lenny's Lawn Care. We introduced a whole new company that we're going to be working with. And we talked about that depreciating adjusting entry and how to calculate it and how to record it. Now, we were depreciating equipment in our video, part 1 from Chapter 7. Equipment's not the only thing that we depreciate. Pretty much any kind of asset that we're going to be using over multiple accounting periods is going to get depreciated. That could include equipment, it can include a building, a vehicle, machinery, furniture, computer equipment. It could even include parking lots and sidewalks. It doesn't include land. Land is not assumed to have a finite life. It's assumed to go on and on and on and on. So we don't depreciate land. That's pretty much the only long-term asset that we use over multiple periods that we are not depreciating. So we depreciate all kinds of crazy things. If you think about Kings Island, in our discussion topic this week, we talk about an island of depreciation. And Kings Island will depreciate all those roller coasters that we love to ride on in the summer. And took a note from their financial statements here. And you can see property and equipment are recorded at what they paid for it. And then it talks about how they depreciate. Look at this. On a straight line basis. Well, hey, you all know how to do that. We learned about that in the video before. And look at that, rides. Got the roller coasters going on. I'm a Diamondback guy myself. Approximately 20 years. And when they build a roller coaster, they're going to depreciate it over a 20-year useful life. Doesn't mean that they can't use the roller coaster more than 20 years. You remember Vortex was around for maybe a little bit more than 20 years. Obviously, the Beast has been around for well over 20 years. I think the Beast is actually older than me. So it doesn't mean they can't use it for longer than that. That just means they're going to spread the cost out of those roller coasters over 20 years. So here we are. We're ready for February at Lenny's Lawn Care. I've got the general ledger at the beginning of February up. You'll notice that the revenue accounts here and the expense accounts have all been closed to zero through that closing process that we looked at in Chapter 5. And remember, we earned a $7,075 profit or net income in January. So that all got dumped into retained earnings when they closed out the revenue and expense accounts. Everything else, all the balance sheet accounts are still there with their new balances in them as of February 1. So here we go. Let's knock out February. In February, we got a new adjusting entry that deals with supplies. And we talked about in the part 1 video, supplies are basically things that we're using to keep the business going. It could be office supplies, maybe Post-it notes, printer ink. It could be supplies related to lawn mowing, like oil filters and shop rags and lawnmower blades and that kind of thing. So what's happening with supplies is when we use them, they're an expense. If we have them sitting on a shelf somewhere in a supply closet, it's an asset. We can use them later on. So we have to learn how to put supplies in an asset account and then take them out as we use them up. And that's exactly what we're looking at here. Let's take a look. On January 3rd, Lenny's bought supplies it needed for the month of January. If you remember, that was $925. And we just recorded it to supplies expense because we were going to use them all up in January. We're going to use them all up when we bought them. So now here we are. We're getting a special offer. Ooh, that's exciting. Our supply vendor has offered to give us a 20% discount and a free storage tank. Ooh, that sounds like some pretty good perks right there. What's the catch? Well, here's the catch. To take advantage of the offer, we are required to buy all at one time, $11,000 of gas and maintenance part. Holy smokes, $11,000 worth of supplies. We can't possibly use them all in the month of February, so we're going to have an asset here. Lenny's decides to take advantage of the offer. On February 1, he buys $11,000 worth of supplies from the vendor. All right. So that's entry number one we need to make. We need to record where we buy $11,000 worth of supplies on February 1. Look at that. The handwriting is getting better and better. Have you noticed that? I'm really proud of my handwriting. I don't boast a whole lot, but that's pretty good right there. We got supplies going on. And you don't have to put this. I'm just kind of putting it in there so you'll know. We're talking about the asset account. I'm literally buying $11,000 worth of supplies and sticking them in the closet or putting them in my gasoline tank in the case of the fuel. And I've not used it yet. Okay? So $11,000. In a baller move, we paid straight cash for $11,000 in supplies. Because that's how we do it. So there we go. We bought supplies for cash. We're going to throw them in the closet and use them as we need them. So I'm going to post that to my ledger accounts here. We're down to $2,075 in cash. Man, we're kind of running low on funds right there. And now we have $11,000 in supplies asset account. The current balance right there. So I traded one asset for another. All right. Now, let's move forward. We got some routine transactions that happen throughout the month of February. And I'm not going to have you write out the entry. We're going to do it backwards. I mentioned before in some of my other videos that you'll get to the point where you can look at a transaction and say, hey, I know what they're trying to do there. I know what's going on just by looking at the transaction without having a description. So I'm going to put that theory to the test right here. I want you to look at the routine transactions that are happening in February. See if you can write a description of what's going on out here for them. Okay? And we'll pause the video and give you a second to do that. And then we'll walk through them and see if your work matches up with what I'm doing. So go ahead and pause, and then we'll come right back and look at your descriptions. All right, so I was bragging on my handwriting, and now it's kind of gone downhill. Let's take a look and see what we have for the descriptions on the routine February transactions that we had during the month. First one we already saw, we bought supplies, paid for them with cash money. February 1, we paid truck rental fee, right? Truck rental expense, paid with cash, but paid truck rent. On February 20th, we collected money on an account receivable. February 28th, we have a debit to account receivable, a credit to revenue. Well, we performed mowing on account. And then finally, February 28th, we paid wages. Were you able to get those without maybe having to go back and look? Could you kind of figure out what was going on just by looking at them? Hopefully. And that's where I'm hoping we can get to that point. If you got to that point and you got all those right, pat yourself on the back. Maybe take a second to go get your coffee and have a good time here. All right, so the next one. We have our entry to depreciate. Here at the end of the month, we recorded all the routine transactions, so we got to do the adjusting entries now. We already know how to do that one. So 2/28. We're going to assume we're not in a leap year here. The end of February. Y'all remember that entry that we recorded to depreciate an asset? We calculated in our other video that it was going to be $1,000 a month. So I'm going to go ahead and put that in. That was our debit. Yeah, we're going to hit that expense account, aren't we? Remember, our expenses are always debits when we record them. And remember that weird offsetting credit, that contra asset we had? Accumulated depreciation. There we go. There's our entry for what we depreciated in the month of February. We're going to make that entry every month. It'll be the exact same unless we buy more equipment or more things that need to be depreciated. Then we'd increase it. If we got rid of the equipment, if we got rid of some of the equipment, then maybe we'd have a little bit less on the dollar amount. But we're going to make that entry every month. We have to depreciate something. So now, with that being done, you can see we've got that entry recorded in the ledger accounts here. Let's talk about that supplies account. We got to make an adjusting entry because we recorded $11,000 worth of supplies at the beginning of the month. But what happens if we use up some of those supplies? All right, we bought them so we could use them. Can't use them all in 1 month, but we know we probably used up some of them. So if we used up any of those supplies, we have to make, you got it, an adjusting entry. You say, well, how do we know if we used up any of the supplies? Well, we send somebody we don't like, maybe an intern, to the supply closet, and we say, hey, we need you to count the supplies. And they stand in there and they count the Post-it notes and they measure the gas and they do everything they need to do to figure out what they have left in supplies. So I told you in video 1, every adjusting entry involves a balance sheet account and an income statement account. Okay, here's our adjusting entry for when we depreciated. Balance sheet account, hey look, expense, income statement account. So again, we're going to make an adjusting entry to move supplies that we used off the balance sheet and over to the expense account, which is an income statement account, right? So here we go. Here's how we make that calculation. At the end of February, we still have a lot of those $11,000 of supplies left. But after we count, we figure up, we now only have $10,125 worth of supplies left at the end of the month. Our accounting records say we have $11,000. Well, that's not right because we know we don't have that amount. So again, those adjusting entries are done to kind of clean up the accounting records. We're cleaning them up. We're updating them to reflect what happened in the month of February. In this case, in regards to the supplies we have on hand. So I've got to figure up what number I need here to get from 11,000 to 10,125. Well, it's not rocket science. It's arithmetic. If I began with 11,000 and now I only have 10,125, I've used up, let's see here, I'm going to use my calculator here. 10,125, I've used up $875 worth of supplies in the month of February. Right on. Everybody see what I'm doing there? I started with 11. I counted. I only had 10,125 left. So I must have used up the difference. I've used up $875 worth of supplies. So at the end of February, I've got to make an adjusting entry to reflect the fact that I've used up $875 worth of supplies. Every adjusting entry we do will have a balance sheet account and an income statement account. So here we go. I used up $875 worth of supplies. So that becomes an expense. The expense account reflects what I've used up in the month, right? Whether it be wages expense, I've used up somebody's labor, rent expense, I've used up rent, whatever the case might be. That expense account reflects what I've used up in that period. And then just that asset account. Supplies, right? So there we go. That makes that asset account come down to the 10,125 that reflects what I actually have on hand. So there we have it. When I post it to the ledger, there's my $875 credit. There's my debit. My expenses have gone up. My supplies have gone down to the balance that we need. And we can see that in the T account for the supplies ledger right there. We used up $875. We're taking it out of the asset account, and here comes another arrow, and we're dumping it into the expense account to show that we've used it up. Now, financial statements, we're not going to have you write this out. But basically, just like we did in the other video, I feel like I've said in the other video about 20 times now, so I apologize for keep saying in the other video. We start with that income statement. We fill that out using the ending balances in our accounts as per the general ledger, making sure we put the accumulated in as a negative. There we go. I got net income, $6,775. Now my balance sheet will fill that out second because we have to have that net income number. I add it to the beginning retained earnings. Beginning retained earnings was $24,250. and I'm adding to that my net income. So I'll do a little bit of math on that one. But you can see our balance sheet, in fact, does balance. Assets equal total liabilities and equity. So we're done with February. Take a deep breath, and let's go ahead and we'll jump right into the next month, the month of March. But before we do that, if we don't make that supplies adjusting entry, if we just leave that $11,000 alone in supplies and we never adjust it, we're overstating our assets, aren't we? And that's a big accounting no-no. You never want to overstate your assets. Kind of like if you're on a dating website and you put a picture up of yourself that you've doctored in Photoshop. Maybe you're overstating your assets a little bit. And then when you finally meet somebody face to face, you're going to be like, wait a second, you don't look anything like your picture. You've overstated your assets. Bam, you're busted. You're in trouble. Same thing happens in accounting. If we overstate our assets and make our company look better than it really is, eventually we get in trouble. We get busted on it, called fraud, and people go to jail, and the company goes bankrupt, and all kinds of bad things happen. So we don't want to overstate our assets. Our expenses would be understated because we didn't record supplies expense, and again, we're overstating net income, how much money we've truly made in profit if we understate our expenses. So, moving ahead, the month of March, let's go ahead and knock that out. Our routine transactions, we paid truck rent, we collected account receivable, we paid wages, we sold mowing services on account that we've completed, we've depreciated the equipment for the month of March, and now you see we got 2 more to make. We've got to make that supplies adjusting entry. We also have a new one we have to make right here that I'm getting ready to talk about for the month of March. There's my ledger. After all the routine transactions and my one adjusting entry have been posted. Let's talk about that supplies adjustment. If you remember, we finished up the month of February with $10,125 in supplies. So that's what we begin March with, right? Our ending balance in 1 month on the permanent accounts, asset accounts, liabilities, and equity becomes the beginning balance in the following month. So we began February with 10,000. Oop, I'm on the wrong side here. Can I erase that? Let's erase that real quick. There we go. So we began the month of March with 10,125 in supplies. And that supplies asset account, didn't we? We had our least favorite intern go into the supply closet and count, and they came up and said we have $9,000 in supplies left at the end of the month. So that's where we're at the end. And don't get confused. Your homework has something that looks pretty similar to this where we're calculating our balances. Don't get confused by that. You can kind of see all it is a T account, gang. There's my debit. There's my credit. There's my crooked line for the T. All this stuff over there is just description. So you can kind of consider that as not really part of the T account. It's just kind of asking you questions over here. So don't worry about that stuff so much and don't let it confuse you. That's our T account right here. We began with 10,125. We ended the month with 9,000 in supplies. What adjustment do we need to bring that 10,125 down to 9,000? Just like we did before, simple subtraction. 1,125 is what we used up. 10,125 minus 9,000. So let's go ahead and make a journal entry for that. Again, we're at the end of no, we're in March now, aren't we? How many days are in March? I don't remember. January 31 days in March? Yeah. There's a little trick you can do where you count your knuckles. You all learned that in elementary school? The January, February, March, when you hit the knuckle, it's a day that has, or a month that has 31 days in it. Kind of handy. So here we go. We got to record 1,125 in supplies expense. Used it up. And we're taking it out of that asset account. I mentioned in some of your earlier homework, it's always important to label your account fully. And this is kind of what I was talking about. You can't just put supplies because it could be supplies expense. Wages could be wages expense, wages payable. So it's very important that you label your account completely to accurately capture what that account is. Okay? Because there's a difference between supplies expense and supplies. One's an asset that we're holding. One's an expense where we've used it up. There we go. Look at that. We moved 1,125 out of the asset account into the expense account. Every adjusting entry, remember, say it with me, one balance sheet account, one income statement account. Now, our final adjusting entry in Chapter 7. We are making what we call in accounting an accrual entry. And you may have heard that accounting was accrual class, and it's absolutely right. We do a lot of accrual stuff in accounting. So what I mean by accrual, it just means to kind of gather up and count, okay? Like when you accrue interest at a bank, you're gathering up interest. It's the exact same idea in accounting. We're accruing something that has happened by making an accounting entry for it. So we make these entries when cash hasn't really switched hands yet, but we still have had an accounting event happen, okay? In this case, somebody has worked, but we haven't paid him yet. An accounting event has happened, somebody has worked, but cash hasn't switched hands yet because we haven't given them a paycheck. So here we go. This is a wages payable accrual. Accrual. Boom, right there. As previously indicated, on March 29, Lenny's paid its employees for the work performed during the first 29 days of the month. But, and it's a big but, Lenny's employees worked on the final 2 days of the month. Those final 2 days have to be counted in the month of March, right? We're all about matching up stuff that happened to the month that it happened in. That way we can accurately reflect profit for that month. So, we worked 3/30, 3/31. The employees are going to be paid in April for the 2 days in March. So we need to record that expense of them working those 2 days in March. We need to record it in March. And it says we calculate that they earned $18.25 for the final 2 days. They're going to be paid in April. So down here, it says we blank revenues expenses in the month they happen. We record revenue and expenses in the month they happen, even if money or cash doesn't change hands in that month. That's called accrual accounting. We call that an accrual. We record an entry even if money didn't trade hands. And accounts receivable, when we sell something on account, that's an accrual. We sold something, money hasn't traded hands, but we still record it. And part of that is that idea of matching. We match up revenue and expenses to the month that they happened in. All right? So, real easy entry right here. 1,825. 2 days of work. We count the expense in the month it happened in. So I got wages expense right there. We already know what that account is. We've used that before. But now for my credit, I don't have a cash credit because I haven't paid them any money. I got a wages payable. I am accruing the 2 days of labor in the month they happened in. Going to pay them in the following month. Wages expense, wages payable. And you might look at that and say, well, that's so stupid. Accounting, maybe you feel is stupid in general, but especially this, because you might look at that and say, okay, so I'm going to make an entry, and then 2 days later in April, when I pay them, I'm going to have to somehow get rid of that entry. It's just dumb. Why don't I just wait until April and just record it then? The problem with that is we want that wages expense to show up in the month it happened. $18.25 doesn't seem like that big of a deal, but imagine Walmart. If Walmart took that philosophy, I would just wait until the following month and record it. Well, you could be talking millions of dollars in wages expense, okay, for a big company like Walmart. So it's very important that we always match up the expenses in the month they actually happened in. There's our ending ledger, fresh off of posting the wages expense and the wages payable. I got my income statement account, got my balance sheet account right there. So, speaking of which, let's go ahead and take a second. Now we'll go ahead and fill out the income statement and the balance sheet for the month of March, and we're going to use again our ending balances right there off of our ledger accounts. I'll give everybody a second to fill that in, and then we'll call it a day here for chapter 7. Now I'll pause and let you all fill that in while I do the same. Okay, hopefully you've had an opportunity to fill in your financial statements here. I'm going to walk through the numbers that I came up with. We got on the income statement, our revenue, again minus all our expenses, is going to equal our net income. We need to do the income statement to begin with so we can get our number for ending retained earnings on the balance sheet, because you remember ending retained earnings is going to be that beginning retained earnings balance plus what net income we have. In chapter 10 we talk about how we subtract dividends that were declared and paid out of that. So that's a little bit down the road, but for right now, beginning retained earnings plus our net income. If we had a net loss, we lost money, we'd subtract it out of that retained earnings balance. So we go over to the balance sheet, and hopefully you remembered to subtract out your amount for accumulated depreciation. You didn't add that in, but it's a subtraction, contra asset. I got my total assets, I got my wages payable. Unearned revenue we talk about in chapter 8. I'm really excited to share that with you. You come back for that video hopefully. We got common stock, we got retained earnings, our ending balance updated with our new net income. Total liabilities and equity is equal to total assets. Right on. So we got it nailed down. We're good to go. Now it's your turn. I got 2 homework problems that I want you to look at, 7.3 and 7.6, and we're going to turn all those in one shot. The ones we're doing for now and the ones we did in our other videos, 7.1 and 7.2. Throw them all in the same workbook template and get them my way, and you'll be good to go for chapter 7. Chapter 8, we continue on the adjusting entry train, talking about that unearned revenue. And so good times in chapter 8 to look forward to there. If you have any questions as you're going through and doing your homework, please let me know. If you have any questions, not only about homework, but just about in general. Maybe there's a concept you didn't quite understand, or you're struggling with wrapping your brain around, now's the time to talk about it before we get to that midterm exam. So definitely take a minute, reach out to me. We can correspond and knock those things out via email. If you need a little bit more hands-on, we can do Zoom, live Zoom meeting where we can kind of share our screens back and forth and work together to tackle whatever it is you're working with. So we'll leave it at that and see you back here for chapter 8 next week. Have a good week.